Welcome to the deep dive. So if you thought the whole ride-sharing and delivery scene was kind of settling down, maybe getting a bit predictable, well, Uber's Q3 2025 results just threw a wrench in that.
They really did. The company itself called the quarter outstanding.
Yeah, and it wasn't just good, it was this acceleration. It feels like they're bending the rules of large numbers here.
Absolutely. I mean,
Okay.
22% trip growth year over year. That's the fastest they've seen since, 2023? And crucially, hitting record profitability at the same time.
Okay, so that's what we're digging into today.
Exactly. We've gone through the Q3 earnings call, the supplemental data, all of it. And the mission isn't just to look at the big headline numbers.
Right.
We really want to unpack the 6 strategic areas they keep talking about. How are they planning to turn, a single ride into a lifetime customer? And what's this tech advantage they're building?
Okay, let's start with the financials then, because that's what's funding everything else. The top-line scale is, well, it's huge.
It is. Gross bookings, that's the total value of everything going through the platform, grew 21% year over year.
And hit almost $50 billion, right? Like $49.7 billion.
Almost, yeah. $49.7 billion. And importantly, that wasn't just, currency fluctuations helping them out. It was 21% growth, constant currency. The demand is real.
And where's that demand coming from? More users, or users using it more?
Both, actually. That's the key. Monthly active platform consumers, MAPCs, they grew 17% year over year, up to 189 million people.
Okay, 189 million.
But, and this is interesting, the average number of monthly trips per user also went up by 4%.
Ah, so they're getting new people and getting the existing ones to use Uber more often?
Precisely. It's a potent combination. You're winning new customers and deepening the relationship with the ones you already have.
And you see that in the core ride-sharing business.
Definitely. Mobility trips specifically, just rides, accelerated to 21% growth.
Wow. And they dropped this nugget about Halloween weekend, didn't they?
Oh yeah, over 130 million trips. And more than $2 billion in gross bookings across both mobility and delivery just in that one weekend.
That's incredible volume. It shows they're not just a commute tool anymore.
No, they're really embedded in cultural moments, big weekends, holidays.
Okay, so massive volume. How does that translate to the bottom line? Profitability.
It translates very well, actually. Adjusted EBITDA, their main profit metric, hit a record $2.3 billion.
$2.3 billion,
Right.
and that's up significantly.
Yep, 33% year-over-year growth. And the margin, the adjusted EBITDA margin as a percentage of gross bookings reached 4.5%. That's up 40 basis points from last year.
So even at this scale, they're still finding ways to become more efficient, more profitable.
They are, and they expect that to continue. The Q4 outlook is for high teens growth in gross bookings, maybe 17, 21%, and low to mid-30s EBITDA growth, so like 31, 36%.
Strong guidance. And what about actual cash? Are they generating free cash flow?
Oh, absolutely. Exceptionally strong. $2.2 billion in free cash flow just this quarter. And if you look at the last 12 months, the trailing 12 months, they've generated nearly $9 billion in free cash flow.
$9 billion. Okay, with that kind of cash coming in, you can definitely afford to make some big bets on the future.
Exactly. Which leads us right into those strategic pillars. Let's start with pillar 1. Turning that trip experience into a lifetime experience. This is all about cross-platform usage, right?
Yeah, getting someone who takes rides to also order food or groceries. But how big is the gap right now? How many people are actually doing that?
It's surprisingly low. In markets where they offer both rides and delivery, only about 20% of people actively use both.
Only 1 in 5.
Yep, and get this. 30% of their core riders have never tried Uber Eats, and a whopping 75% haven't tried their grocery and retail offerings.
75% haven't ordered groceries or convenience items. That feels like a massive missed opportunity if you trust them for a ride.
Exactly. But here's why it's such a huge focus. The incentive is massive. Those users who do use both platforms, they spend 3 times more.
3 times more.
And maybe even more importantly, they retain 35% better than the single product users.
35% better retention. That's the golden metric for a platform like this,
Wow.
isn't it? Lifetime value.
It absolutely is. So the whole strategy here is about making it super easy, almost seamless, to switch between services. Personalization is key, suggesting a Starbucks order when you're heading to work, or maybe groceries when you land at the airport.
And using those tabs at the top of the app, I guess.
Yeah, making it obvious and easy to just tap over to Eats or groceries, reducing friction.
And the Uber One membership must be central to this. How is that rolling out?
Uber One is critical. It's the glue. It's now in 42 countries. That's up from 28 just a year ago. And it already covers 2/3 of their delivery gross bookings.
2/3 of delivery GB is under membership. Wow.
Yeah, and they're pushing annual passes hard because the retention data for annual members is even better. Now, they were pretty open about something interesting. Moving a really frequent user onto a membership plan is actually profit negative initially, for the first few months anyway, because of the discounts, the free delivery.
Right. So they're taking a short-term hit on margin for those users.
Exactly. It's a conscious investment. They're essentially buying that long-term loyalty and the increased spending that comes with cross-platform use.
And they've modeled it out. They know when it pays off.
Yeah, they said it becomes net positive after about 6 months, mostly because of that huge jump in retention and the fact that members tend to try more services. It's a calculated gamble on lifetime value.
Okay, that makes sense. So that focus on locking in customers and getting them to use more services feeds right into Pillar 3, which is this push beyond just restaurant food into general local commerce, grocery and retail, or GNR.
Yes, and GNR is really what's driving the acceleration in the overall delivery business. Delivery gross bookings grew 24% constant currency, the fastest in 4 years, and GNR is the engine.
Why is GNR such a big deal strategically?
Scale. Just sheer market size. The global food delivery market is estimated at, maybe $2 trillion.
Okay, $2 trillion. Big number.
But the grocery and retail addressable market, estimates put that at $10 trillion.
10 trillion. Wow, okay, that's 5 times bigger than food.
Exactly. The potential runway is just enormous compared to restaurants alone.
So how big is their GNR business right now? Is it still tiny, or is it gaining real traction?
It's gaining serious traction. It's already at about a $12 billion gross bookings run rate.
$12 billion already. That's not small.
Not at all. It's a substantial business in its own right, and it's growing much, much faster than the restaurant side. Plus, it's a new way to bring people onto the platform. 7% of Delivery's first-time users are coming in through GNR now.
And they're really going wide with the partnerships, aren't they? It's not just supermarkets.
No, they're aiming for everything delivery. They mentioned Best Buy, Home Depot, Costco, Kroger, Petco, Sephora, electronics, DIY stuff, pet supplies, cosmetics. It's moving way beyond just milk and bread.
It's a real consolidation play for local commerce delivery.
Yeah.
Now, you mentioned something important about the economics variable contribution positive. What does that mean, simply?
Yeah, that's a key milestone. It basically means that for each individual GNR order, after you pay the courier, cover customer support for that order, and any transaction fees, Uber is making a small profit on that specific transaction.
Okay, so the unit economics work. Each sale makes money before overhead.
Exactly. It doesn't cover the big fixed costs yet, like the engineers building the app or marketing or HQ costs, but it proves the model can scale profitably. They can push this $12 billion business hard without losing money on every single delivery.
Got it. That's crucial for scaling something that big. Okay, let's shift gears to the really long-term big tech bets. These are the things that cost a fortune now but could define the future. We're talking autonomous vehicles, AVs, Pillar 2, and generative AI, Pillar 6.
Right. The AV strategy is quite interesting because Uber isn't trying to build the whole self-driving car themselves.
They learned that lesson the hard way, maybe.
Perhaps. Their goal now is to create this hybrid network where human drivers and AVs work together seamlessly on the Uber platform.
Okay, so they provide the network, the demand.
Exactly. And the partnership with NVIDIA is central here. NVIDIA provides its Hyperion platform, basically the core tech for Level 4 autonomy, to car manufacturers, the OEMs, like Stellantis, who committed to putting it in 5,000 vehicles to start.
So Uber connects the NVIDIA-powered cars from Stellantis or whoever to their riders and delivery customers. What does Uber bring besides the network?
Data. Highly specific, valuable, real-world driving data. Think about navigating a chaotic airport pickup zone or handling drop-offs after a huge stadium event. That's the kind of complex data AVs need to learn, and Uber has tons of it.
And are we seeing any results from this hybrid approach yet?
Early signs are actually pretty stunning. The markets where they have AVs operating alongside human drivers, they mentioned Austin, Atlanta, Phoenix, using Waymo vehicles there. Those markets are growing more than twice as fast as the rest of the U.S.
Wow, twice as fast. That makes sense. AVs add supply,
Yeah.
increase efficiency. But wait, they said something about driver earnings in Austin, right? That seemed counterintuitive.
It did. That was fascinating. They said that driver earnings in Austin, their most mature AV market, have actually outpaced the rest of the U.S.
How? If you add robot cars, wouldn't human earnings go down?
That's the paradox. The theory is that the AVs right now are handling the more predictable, maybe lower value trips. Think simple cross-town routes, maybe scheduled airport runs during steady times.
Okay.
By taking that kind of bread and butter demand, it frees up the human drivers to focus on the more complex trips, the longer distance rides, and especially the high demand, surge price trips where human judgment is still essential.
Ah, so the AVs soak up the basic stuff, and the humans get the premium, higher-paying work.
That seems to be the dynamic they're seeing.
Right.
The AVs are augmenting the network, increasing overall volume and efficiency, which ends up benefiting human drivers, at least in this phase.
That completely changes the narrative from AVs replace drivers to AVs and drivers coexist, maybe even help each other, at least for now.
For now, yes. Which brings us to how they fund these AV efforts, because AVs are definitely not profitable yet and won't be for years. That's where their barbell strategy comes in Pillar 2 funding.
Right, the barbell. Explain that again.
Think of a weightlifting barbell. You've got heavy weights on both ends and a thinner bar in the middle. For Uber, one heavy end is their high-margin premium products.
Like Uber Black, Reserve, Uber for Business.
Exactly. Those services generate really healthy margins and reliable cash flow. That cash is then deliberately used to fund the other end of the barbell, the big, expensive, potentially unprofitable bets.
Like AV development.
Like AVs, yeah. And also their low-cost offerings that are needed for scale and affordability, like UberX Share or the Wait and Save options. It's an internal subsidy model. Premium pays for the future tech and the basic access.
That's a smart way to balance investment. Okay, briefly on the other big tech piece, generative AI, Pillar 6. Beyond the obvious stuff like better pricing or personalization, they mentioned something new called multiple gigs, which is Pillar 4.
Yeah, this is really clever. It leverages perhaps their biggest, most unique asset, the 9.4 million drivers and couriers on the platform.
9.4 million people. That's enormous.
Huge. And Uber AI Solutions is realizing this isn't just a workforce for moving people or things physically. It's a massive distributed network of humans who can do digital work too.
Digital work? Like what?
They're creating ways for these drivers and couriers to earn money beyond driving or delivering. Things like helping train AI models, annotating videos so algorithms can learn, judging the quality of search results or chatbot responses.
So Uber is becoming a broker for digital gig work, using its existing workforce.
Kind of, yeah, tapping into that huge digital task economy. And they made a point that it's not all low-skill stuff. Some tasks, like evaluating complex AI outputs, apparently require serious expertise, even PhDs for some roles.
Interesting. So they see their workforce as a multi-talented pool, not just drivers.
Exactly, a dynamic resource.
Okay, last major area, Pillar 5. Let's call it operational excellence, the less flashy stuff that still makes a big difference.
Definitely. And it delivers real money. One interesting point was growth in less dense areas, suburbs, smaller towns. Those markets are actually growing 1.5 times faster than their traditional dense urban strongholds.
Why is that?
Products like Wait and Save seem perfectly suited for that suburban user who maybe isn't in a huge rush and is happy to wait 10 minutes if it guarantees a lower fare. It optimizes the network for different needs.
Makes sense. And the other huge operational win they highlighted was insurance savings, right?
Massive. This could be huge for future profitability. They had some big wins in 2025, both legislative and technical.
Like in California.
Yeah, the big one was getting certain underinsured motorist coverage limits reduced significantly from like $1 million down to $60,000, $300,000, depending on the situation. That alone is a game changer for their costs.
And they combine that with tech.
Right. They have this driving insights dashboard for drivers. It gives feedback, helps them improve safety scores. The combination of lower required limits and actually safer driving, they think, will save hundreds of millions of dollars in 2026.
Hundreds of millions. And what are they doing with those savings? Pocketing it.
They actually committed to passing it on, using it to lower fares for consumers to maintain that competitive pricing edge.
That's smart. Okay, one last point on operations and maturity. I noticed they talked about shifting their focus from adjusted EBITDA towards adjusted operating income, or AOI. Why does that matter?
It signals a real shift towards being viewed as a mature, sustainably profitable company. Adjusted EBITDA, as we know, excludes some pretty big real costs, like stock-based compensation paying employees with stock and depreciation.
Right, stock-based comp is a huge expense in tech.
Huge. AOI includes those costs. So by making segment leaders accountable for AOI, they're forcing them to manage the full cost of doing business, including the cost of attracting and keeping top talent with stock grants. It shows a commitment to real profitability as they scale.
Okay, so pulling this all together from our deep dive, it feels like we've got a company that's uh, firing on all cylinders right now, hitting massive scale, accelerating growth. That 22% trip growth is key.
Yeah, executing incredibly well today.
But while doing that, they're aggressively building a potentially much larger future,
Yeah.
maximizing customer lifetime value, getting that 3x spend from cross-platform users, and using that barbell strategy to fund these huge bets like AVs and GNR.
Absolutely. And that aggressive investment, deliberately sacrificing some near-term margin points to fund that disruptive growth, that's really the defining characteristic right now. They're pouring money into things like AVs that won't pay off for years and scaling that $12 billion GNR business even if it dilutes margin temporarily.
Which leads to the final thought for the listener.
Right. When you look at a platform company like Uber making these huge multi-year bets, how do you judge if the strategy is working? They're committed to growing total profit dollars every year, which is good, but they're also deliberately holding back margin expansion to invest.
So what's the better indicator?
That's the question. Should you focus primarily on that steady growth in total profit dollars? Or should you look more closely at the adoption rates and the scale of the new ventures like GNR hitting a $12 billion run rate or AVs doubling market growth rates? Is that accelerating adoption the truer sign that the long-term value creation plan is on track, even if it costs margin today?
Fascinating tension. Present profits versus the pace of future disruption. Definitely something to think about. Thank you for joining us for the deep dive.